This session, we're going to be looking at this kind of collision between financial and non-financial risks. And there was a time where these were seen as very different things, you know, and I know regulators in Australia talked about, you know, what do we do about non-financial risks? We don't see that boundary as being anywhere near as clear-cut these days. We see the boundaries much more blurring. And our first speaker is going to talk about those that collision or those blurring of boundaries, and that is Virginia Harper Ho, and she's going to be followed by Nurgozhayeva, and it's over to you, Virginia.
Thanks, everyone. Let me just. Oh, good. Slides are working. Thank you. Well, I was inspired by our very first speaker today, Kyung-Hoon Chun. I wish to emulate the pace and the relaxation that he brought to me this morning, but I fear that I speak in the opposite direction. So I apologize, and I have a lot that I'd like to say in a short time, and I know they're going to yell at me in the back. So I'm going to probably speak faster than I should. But anyway, I want to, first of all, say thank you to Dan and the organizers and everyone here for putting this together, and to Roza for agreeing to comment on a very unfinished draft paper. But basically, what I'm looking at today is to take kind of a materiality lens, which we're all very familiar with from accounting, from financial disclosure, financial reporting, et cetera, and some other contexts, and to look at some of the issues that were raised earlier today in Gen's paper on the kind of corporate governance overlaps with that, and particularly the whether there's an obligation of corporate officers to exercise risk oversight and risk management with respect to at least climate risk and maybe other sustainability risks. So we're going to kind of return to that topic. Anyway, so again, as we've already discussed in the sessions yesterday, and as many of you are well aware, mandatory climate disclosure and other green finance reforms are rapidly coming online worldwide, as well as here in Asia. And indeed, Hong Kong and Singapore are updating and introducing new ESG regulations in fierce competition as we speak, building on various climate action plans and green finance policy documents that are designed to move companies and, in fact, the region toward net zero or carbon neutral goals that align with the Paris Climate Accord. So the questions that I'm looking at today follow from the observation that all of these rest on financial materiality, and they were designed intentionally that way to kind of keep us at the core of what finance does well, about what markets do well, about what companies have been focused on. And financial materiality is indeed the bedrock of green finance in both of the markets, Hong Kong and Singapore, that I want to focus on. But I'm curious if really ESG materiality is in fact business as usual, even if we are focused on financial materiality of ESG factors. So that raises a couple of questions, which is, number one, how does ESG materiality fit or clash with how materiality has been defined in these markets historically? And Jennifer's already alluded to this blurring, so I really want to speak to that blurring. Okay, and number two, what are the implications of that blurring for company law, and how is company law affected when financial regulation and capital market regulation specifically is focusing more heavily on this kind of blended version or understanding of financial materiality that does sweep a bit more broadly than we're used to. In particular, Ernst Lim and Umakant Vartil have both written already on their kind of position, and they've the question is, will the embrace of stakeholder financial materiality by capital market regulators shift how corporate fiduciary duties, corporate purpose, and indeed material risks are understood? And they're suggesting yes, that this kind of push in capital markets toward disclosure and other areas will move the ball forward indirectly by kind of changing, again, indirectly rather than directly, what corporate officers are responsible for. But I think there's another alternative, which is that the tensions between corporate law and indeed common law interpretations of materiality may in fact impede this corporate transition to a sustainable future that all the regulators seem to be wanting to push toward. So again, I'm starting from this materiality lens kind of as a thought experiment. You may feel like it works or doesn't work. I'm curious to see what Roza thinks. But we know that materiality matters in a bunch of places, most obviously in accounting and audit standards. Within securities regulation and the common law associated with that, we see it materiality being defined in kind of for two purposes. One is to limit the scope of affirmative disclosure obligations. So obviously there's a materiality threshold for that, and that aligns with kind of the accounting and audit definitions. The second purpose, and this is where most of the litigation is and most of the common law is developed, is to define the bounds of potential civil or criminal liability for fraudulent or misleading statements, for insider trading, relying on non-public information. So a lot of the law, at least in Hong Kong and in Singapore, it turns out, comes out of the insider trading context. And when we're asking like, well, what's material for purposes of holding you liable for insider trading? So the third place, though, where we have materiality concepts beyond the disclosure context, really, is corporate risk analysis and risk management, which is supported by listing rules, corporate governance codes, and the like, which may require corporate management to identify and disclose significant or material risks and risk factors. And so there's this kind of corporate governance overlap already in the law with kind of securities regulation, et cetera. So taking these kind of baseline contexts, I put on the left column is kind of those areas of law that I was just walking through, kind of the general materiality standard. Then we have rules for continuous disclosure, insider trading, general prohibitions on securities fraud in disclosure. And then we have risk factor disclosures, which overlap much more directly with corporate governance obligations. And so you can, both Hong Kong and Singapore follow the IFRS, so that we've got a general definition there about what materiality means. It is entity focused for a specific entity, not portfolio focused. And we could talk offline about that, but that's actually a meaningful distinction when we're talking about ESG and what are the financial rationales, because what matters to the firm might be different than what matters to investors. And that's something we can explore later. But anyway, the main definitions here are all price sensitive. Like, it's material if it affects the market price, right? Because that's what we care about when we're litigating or we're seeking to impose liability or considering it liability for insider trading or for fraudulent misstatements, right? We want to know, was there a price effect, or in Singapore, was it trade sensitive? So a little bit broader definition. Another way of looking at these baseline standards is kind of on a timeline in terms of short term to long term. So if you think of like the price sensitive and trade sensitive materiality tests, obviously you know, we can do event studies, like market impact in this particular period of time, right? But when we're talking about managerial decision making, we're looking, you know, medium term, long term, perhaps. And so that's where we get into this blend into, you know, what's the scope of risk oversight, for example? What's in the best interest of the company? Or in kind of that middle box there, what's important from a trade perspective or an investment perspective, or maybe even a little bit more broadly, voting decisions and engagement by shareholders. Okay, so there's kind of a spectrum in terms of time and scope, even within kind of our baseline understandings of materiality, that I think complicates the story when we're thinking about where does, you know, ESG materiality, even from a financial standpoint, fit into this. Okay, because these are all kind of standard baseline definitions, right? So bring into this transnational sustainable finance reforms. In the paper, I want to look at three different categories of green finance regulation and how they intersect with all this. So the first one is the obvious one, which is corporate climate and sustainability disclosure mandates, which again are coming online everywhere. The second one is taxonomies, and if you're not familiar with that term, taxonomies are basically standards for defining what's green or what's not green or what's transition risk, for example. And so Europe has led in this. China and Europe have worked together on a common ground taxonomy that Hong Kong is building off of. There are, I think, 20 jurisdictions at least in the world that are working on these, but they're used particularly for green bonds, but also for other investment activities to define what do we mean by green and prevent greenwashing. Okay, so that's the second category. And then the third is regulations of investors, and not all investors, but again, some of our main institutional investors like banks, other financial institutions, asset managers. So a lot of them are coming under regulation, not only in Europe, but also here in the region. Prudential climate risk measures for banks, ESG fund regulation, and then separate disclosure mandates that are directed at asset managers at the portfolio level. So these are all kind of the three categories I want to look at. And as Jennifer alluded to, some of you saw this slide yesterday, but ESG is not different from other factors that might be financially material in the sense that it's dynamic. What's material to the firm and its investors from a financial standpoint can change depending on what the company's doing, depending on what's going on in the economy. Okay, but I think this is a helpful chart because what it shows is that in the pink box at the lower left, there are different ways we can think about materiality, and that kind of pink box represents what you would put in financial statements, what's already reflected in the financial accounts, again, on a couple year basis, right? The middle box is where the challenge of my paper comes, because these are a subset of sustainability topics, perhaps climate risk, perhaps others, that are material to enterprise value creation or enterprise value preservation, but they might have not have originally been in the financial statements in the past, okay? But they might be at some point in the future. And then beyond that, in the gray box are these kind of double materiality standards that don't really have to do with financial impact on the company itself or on its investors, but have to do with externalities or the company's impact on other stakeholder-related issues. Okay, so all of the measures that we've been talking about so far are all dealing with the pink and the purple box. Okay, but it is obvious that extending to the purple box or the middle box, whatever color you think that is an extension of how we've traditionally thought about financial materiality. Okay, and that's where green finance regulation is taking us. Okay, but that's again kind of new territory. Europe's regulations are double materiality and focus on kind of the gray box. So the implications of this is that even when we focus on financial materiality measures, we are going to be requiring companies and investors to integrate ESG considerations into decision making, again, to account for that purple box. And it necessarily requires companies and investors to identify and measure factors that have both financial impact on the entity and at the same time relate to these broader societal or stakeholder or publicly oriented concerns. Now, both Hong Kong and Singapore have ESG disclosure standards, and that's that first type, and they're committed to following the new ISSB international disclosure standards that are, again, based on financial materiality. And they all build on the TCFD. I put this slide up here yesterday, too. The main point from this slide is not all the text, but to observe that the foundation of all these green finance disclosure standards requires disclosure on governance practices that in the past were purely discretionary. Okay? It did not used to be required that the board of directors would pay any attention to climate. Okay? You cannot ignore climate unless you want to be named and shamed off of the listing exchange, because now you have to disclose what exactly your board is doing about climate risk. Okay, so just as a quick example, you can't be climate blind anymore, okay? So whether it's financial materiality or not, we're bringing in these factors that used to be a matter of kind of business judgment, rule discretion, and kind of permissiveness in the past. Okay, so disclosure we've got. Taxonomy is kind of work in a different way, and this part of the paper isn't developed in the draft that you have very well. But taxonomies are designed for double materiality. They're designed to tell us what's green. But I'm encouraging us to think that they introduce materiality concepts in a very different way, and again, from an impact, from an externalities perspective. Why? Because, so their purpose is to set the use of proceeds standards for like green bonds or transition bonds or instruments like that. They are also linked to some of the reporting obligations that investors have. Namely, so asset managers, fund managers in Europe are required to report against the taxonomy. So these things are kind of linked. We don't know yet what the taxonomies here in Asia will look like and how closely they'll be linked like this. But if they are, then that brings in an externalities and a double materiality element. There are also kind of impact or externality specific materiality concepts that these taxonomies introduce, namely do no significant harm. Don't externalize harm, basically, is built into the taxonomies. This notion of principal adverse impacts from Europe that investors now have to pay attention to, and minimum social safeguards. I don't have time to talk about all these, but basically these are all stakeholder-facing materiality measures that are being brought in and integrated with the financial materiality disclosures. But this is at the investor level, basically, and investment products. Okay, and there's some examples here on this slide. I'm not going to take a ton of time, but Hong Kong and Singapore have already introduced these because they have guidance, which is essentially binding on asset managers and other institutional investors. Okay, and I'll slow down a little bit on this one. This is the example from Hong Kong. This is the SFC's Fund Manager Code of Conduct. And if you look in the middle, there's some mandates here of what they're required to do. They have to have a climate risk management action plan and monitor it. They have to assess climate risk for all of their investment strategies and funds. They have to do so with quantitative metrics. They have to disclose. They have to produce portfolio level greenhouse gas emissions measures. So there's a lot of stuff they have to do here from kind of a regulatory standpoint. Okay, so this is just kind of an example of what we're talking about. I'm going to go through this list. I don't need to show you the list for Hong Kong and Singapore. I've got kind of a list like that in the paper. But I just want to make a couple observations from all this. So first, again, is that ESG financial risk assessment requires, nonetheless, stakeholder-related risk assessment, even if all we're looking at is the financial impact to the firm, okay? Number two, climate-related financial risk, I will let you know if you haven't read the details of these rules, brings in a kind of widening pool of environmental factors as well. Biodiversity is one of them. Now there's a new standard for nature-related financial risk. So some of you who are balking at the climate risk thing, let me just warn you, that was the conservative thing that we were trying to sell you, okay? So greenhouse gas emissions, resource consumption, and biodiversity are all within the scope of the existing climate risk disclosure mandates, not way out there in the future things, okay? And number three, green finance regulation requires ESG integrated decision making, both from the board as well as from investors at the portfolio level. So my next set of observations is that, I want to circle back to this materiality concept. So on the left, if you look at Hong Kong and Singapore at least, and I think they're pretty representative of other jurisdictions, the limited common law interpretation of materiality is largely restricted to these kind of market impact measures because of the way in which litigation works and the reasons why we've had to define materiality in the common law in the past. Like, it's because we're trying to figure out, should we hold you liable for something that could cause a price swing? Okay, that doesn't fit very nicely with some of the more medium-term and long-term impacts that ESG encompasses, even climate risk. So on the other side, we have that kind of baseline. With regard to risk management, some of the corporate governance and intersections, just a couple observations here, are that the common law interpreting corporate fiduciary duties, we talked a lot about this yesterday, so I won't say a ton about it. In Hong Kong, at least, presumes shareholder wealth maximization. And that's your objective function. That's the corporate purpose. That's what you got to strive for. I understand in Singapore, my view is that it's a little bit more liberal and a little bit more permissive, perhaps. There's not a ton of common law guidance. This is way too abbreviated on the slide. There's not a ton of common law guidance on materiality in the broader kind of corporate risk oversight sense in the Commonwealth, except for some very recent cases like the Climate Earth litigation that Gen mentioned, and then also the case of Tiong versus HC Surgical here in Singapore. So there's not a lot out there, and there's no equivalent in Hong Kong and Singapore for the UK Companies Act, kind of enlightened shareholder value approach. But the main point is that our corporate governance baselines are still very much shareholder primacy, kind of wealth maximization focused, and I don't think that's a bad thing. I just think it needs to be adjusted, and we can talk offline about that. So what are the implications? Number one is that ESG regulation is, I think, compatible with these liability-based materiality rules. I don't think we need to change the price-sensitive rules or the trade-sensitive rules to deal with insider trading. There's some neat papers coming out, I think, in the next year or so on insider trading and ESG that by some scholars I'm curious to look at. But I don't think we need to change the underlying financial materiality principles that all of this is built on. But we need to recognize that these capital market regulations are changing the thought process and the requirements on the reasonable investor. And they are, in fact, introducing, I'm told it's time to wrap up, so I have to be very speedy here, introducing an enlightened shareholder value concept of corporate governance, which is not what the company law says in any of these places, okay? But it's coming in through securities regulation. So the issues that I want us to focus on and the puzzles that I'm trying to get at are, what happens when capital market regulation points corporate governance in one direction and company law stands still or points in the opposite direction? Number two, what happens when listed companies are bound by the standards that capital markets are pointing toward, which is this enlightened shareholder value kind of approach, but again, normal companies, non-listed companies, are following the standard companies ordinance marching orders. Is that a problem or not? Is it something that we need to worry about? I suggest it sounds to me like a pretty significant divide, and if that is a divide, we need to worry about it. So one possibility is that FinReg will drive companies in a more sustainable direction. The other possibility is that existing company law will weaken or undercut the impact of any of these sustainability measures because everybody will just check the box. So I think it's too soon to tell if ESG regulation will make companies more sustainable or if this tension will lessen the effects of regulation. But I think even if ESG regulation succeeds, then we have to worry about a new clash between the fundamental corporate objective that more sustainable listed companies will be following and what everybody else will be doing. So I leave it to you whether that's something we should focus on. So.
Okay, thank you very much, Virginia, for your paper. Yes, you keep saying that it's an early draft, but I really enjoyed reading the paper and I learned a lot, to be honest, and that made me think about a few things that I want to share, and maybe you can, I'm personally curious about. So I wonder what you think about these things. So first, I want to say that it's very timely and insightful paper, you know, disclosure and materiality, and like yesterday we had a seminar on climate and corporate governance. These are very current issues, right? And that's at the age of the debates, you know, corporate purpose and what companies and regulators can do about ESG and climate. And it also pretty much shapes the conversation and the agenda in the boardroom, right? Then I really enjoyed their summary of the nature and variety of materiality. So you kind of explain the essence of materiality. You gave the overview of the materiality from the financial point of view, which is the origin of the materiality concept. And then you also provided sources and scope, and you also illustrate the clash of materiality concept, you know, like depending on the problems that companies are dealing with. So now, as we all know, you know, many jurisdictions start imposing new disclosure requirement, and your paper actually tries to explain what it means for corporate governance, right, and the broader corporate purpose debate. So you know, you also link nicely materiality with the fiduciary duties and shareholder interests. I also like your approach to materiality as an intersection, you know, the conflict that you illustrated on the one hand, company law and the capital and financial regulations. And I also like that you pick up there, you have this discussion about the meaning of the term investor, right? What kind of investor we talk about, whether it's equity investor, institutional investor, present or future investor, and depending on that, whose interest we're trying to address when we talk about materiality. And as you know, different investors, they have different agenda and they have different priorities. You also, I mean, I also like your thick, thin materiality approach. I think it's very nicely. You talk about single and double materiality, but you also frame it as a thin and thick, something that you mentioned yesterday, and I found it a really, you know, nice framing, and the differences and the implications and what single materiality and double materiality actually means in terms of the consequences for the company and for companies and corporate law. Also, you know, the regional perspective, you talk about Singapore and Hong Kong, and these are, you know, financial hubs and basically trendsetters in the region. And I assume what's happening in these two financial hubs would pretty much frame the trend and the regulation in the region in general. So, but with this, I have a few questions. I don't have many, 5, I guess, that I want to ask. So you finished and you mentioned that in the end, the conflict between short-term and long-term, and the conflict between the current corporate law and the corporate purpose framed by company law on the one hand, and then capital market and financial regulations, and that probably leads to the fact that something needs to change. So corporate law, company law needs to address and somehow it reflects these changes that are happening. But I want to push back a little bit because yesterday we talked about fiduciary duties, we talked about duty of care. Today we continue this conversation whether we actually need any corporate law reform, because some scholars might argue that corporate law already flexible enough to accommodate new risks. Like how climate make it different, how climate is different from other externalities. And usually that's what duty of care and business judgment rule allow directors to, definitely do not prohibit directors to think about climate as a risk. So do we need a corporate law reform to deal with such externalities as climate? And also yesterday, when we discussed the second panel discussed fiduciary duties, we talked about that there are other laws like environmental law, and like examples that our panelists gave to us were not about corporate law. We have other laws, and this debate whether we have to target climate and ESG within corporate law or outside corporate law. Do we need to do that? And again, the current corporate law is pretty much accommodating. And the thing is that for directors, climate and ESG might be just another cost, another risk. And then because you talk about corporate purpose, and this is the argument that we received, because the argument whether this risk is changing anything in terms of corporate purpose, because that's just another risk, another cost that the company will deal with, and that's it. How it's different, like these particular ESG risks, how they change the bigger picture and the current status quo. And then that brings me to a single and double materiality, because single materiality treats climate and sustainability-related risks just as financial risks. And that means that basically it's just another financial risk that we address, and we do have frameworks and approach to do that. Do we need to change anything? And if we talk about double materiality, there are lots of questions and pushback regarding double materiality because, it's very expensive. It's quite unclear how the companies are going to achieve that. Enormous data that the company needs to gather and process to adequately assess these kind of risks and adequately report in terms of double materiality framework is actually quite challenging for directors, and whether it's reasonable for directors, whether it's reasonable for us or for regulators or for general public to expect directors to comply with the double materiality standard. Of course, the only jurisdiction that applies, at least as long as I know, is the European Union, right? And then it still remains to be seen how this double materiality will play out in the real life, and whether it's not another greenwashing case and the attempt to do something good, but it eventually would lead to no outcome or no change. And also you talk about the baseline and the shift. And my question is, shift to what direction? Because you talk about single materiality, so you start with a classic financial risk and how we understand classic financial risks. Then you move to single materiality in the context of climate and sustainability, and then discuss double materiality. And then you observe, and it's clear that there is a shift. But then, okay, if we move to classic financial risk to single materiality, then whether double materiality is the next step, or we shift someplace else. So whether it's work in progress, and this shift would continue, and in what direction possibly. So whether we can predict. Yeah. Also, I want to say that, something that Umakan mentioned yesterday, whether, and this is, I think, quite important, whether, because you talk about ESG, but you basically discuss climate primarily, right? And that the question whether we need to distinguish, because most of the reporting and disclosure requirements that you describe are related to climate, but you use ESG a lot, and I think that's a bit confusing. And you also talk about corporate purpose, but in what context corporate purpose is relevant in this case, and also shareholder versus stakeholder. And it looks like either or, but whether it's either or. And my final point, you talk about Singapore and Hong Kong, like you as you put them in one single pool, but I would be curious to know whether there are any differences, or you foresee any different approach, any differences in the way how Singapore and Hong Kong approach these kind of issues. Thank you very much.
Oh, it's my own fault for packing too much into short time that I now am faced with trying to solve the world's problems in 5 minutes. Okay, so let me start from the bottom, which is Hong Kong and Singapore. Again, I talked to them about them kind of together, but I do want the paper ultimately to tease out more of a comparative element between the two. And then also, is there anything from the Hong Kong and Singapore's kind of experience as two different leading global capital markets that are trying to push forward very quickly in this direction? Like, what does that tell the rest of the world? Because I think we can learn a lot from that experience. Very briefly, I believe my preliminary view, and I'm welcome to be corrected by those in the room that know way more about this than I do, but my preliminary view is that where Hong Kong is today and what it's doing in terms of the ESG regulation space is pushing much further than Singapore has so far in corporate governance reform directions. At the same time, Hong Kong is the place, if you look at the common law foundations and kind of black letter law on fiduciary duty, it seems to me that there's more flexibility in Singapore to be kind of stakeholder oriented if you wanted to than there is in Hong Kong, where they've adopted a much more kind of strong shareholder primacy approach. So in sum, I think that Hong Kong is a place where this potential divide between financial regulation, ESG perspective, and kind of the baseline law might be wider than in Singapore, but that's just my tentative kind of thought. I don't know if that's true or not. And it may not matter in the grand scheme, that difference, I don't know. Climate versus ESG, Roza and I talked offline, and I know a number of you have thought a lot about this. Climate is different, and I guess John Coffey's now bothered to write a paper to tell us that. But anyway, it is different in terms of the materiality rationales because of the link to portfolio relevance, where like our greenhouse, this came up at a call, I was listening to a commentary on the SEC final rules, which may be of interest to some of you in the room. So as you know, the climate disclosure rules came out, now they're stayed. But the question was raised in the first draft of those rules. Greenhouse gas emissions were required as they are internationally, even if they're not material to the company. And the reason for that is because they're systemically material. They're material to investors, even if they're not material to your firm. That's the financial rationale, but it's not entity specific. It's not firm specific. And so if we look at kind of the IFRS definition of materiality, the question on the call was, okay, now that the SEC amended the final rules to add a materiality qualifier, what exactly does it mean to have material greenhouse gas emissions? Like, that's the question. How do I know, like, what does it mean that it's material to my firm? Material over what time period? You know, so it kind of does open up an inquiry, right? And the spokesperson for the SEC, the head of the corporate finance division, had a very good answer to that. But and we can talk offline on what that is. And there are rationales, but it will not be for every company necessarily that greenhouse gas emissions are material. So that's a question. With regard to ESG, so I think it is helpful to start from climate when we're thinking about this, because it's clearer. I think all of us can kind of see how climate risk could be material, but it is not the case anymore that ESG is a completely unbounded box like CSR that you can put whatever you want into it. That's not the world that boards are facing. There are measures, there are standards, they're increasingly hardening. They are jurisdiction specific. They are going to continue to be jurisdiction tailored. I can say a lot more about how the EU got to where it is, but it's not a free-for-all. And so I think there are bounds to what we're asking companies to do. If we even move to a double materiality standard, I don't think every jurisdiction will move there. Guarantee you the US will not move there. So I think it's going to be jurisdiction specific. I don't think it's automatically shifting in that direction. The last thing was going back to basically what I wanted to say in response to Gen's paper, which is, do we even need a change in company law? Or would a change in company law be bad? Okay, and so I'm very sensitive to the fact that what's good about the business judgment rule is that we need director discretion. And we need courts not second guessing, and we need no hindsight evaluation, okay? But I don't think we sacrifice innovation by imposing restrictions on certain kinds of externalities. And I'm not talking about regulation now. I'm saying you have to think about it in a UK Article 172 kind of way. You need to consider it. You cannot be climate blind, okay? I don't think that prevents you from innovating. And I think the same baseline rules that we have in general that apply in all of our jurisdictions will keep us from going off the rails in that direction. The business judgment rule will survive. It will be very healthy and well, okay? But, you know, if we look at Delaware, if we look at some ways that other jurisdictions have cabined the scope of managerial discretion, I mean, most of your jurisdictions have a negligence standard, not a gross negligence standard like the US. You already have a limitation and a constraint on what directors are doing that the US hasn't bought into. So the US has other ways of dealing with it. But there's already emerging ways in which we can strengthen risk oversight without killing the golden goose and without getting rid of profit maximization. But I do think, final point, is that there is one incompatibility that corporate law has with this train of ESG regulation, which is I do not think anymore that it is a complete business case for ESG, okay? What I mean by that is that we cannot have shareholder wealth maximization as our lodestar and also address climate risk. I think that those two things do not go hand in hand, partly because of the crisis that we're in with climate. And in that sense, climate is different and we need to pay attention to it. And so should company law change? Does it have to? No. These other rules can work just like public regulation works to bound in the way that environmental regulation worked and all these other things. Yes, now we can look to financial regulation and add it to the mix of tools that we have to regulate companies so that company law can do what it does best. But my argument is that company law is an impediment. If it's an impediment and it's pushing against our success in these other areas, then company law needs to change. So.
Thank you. Yeah, I think it's on now. I thought that was just very interesting what you were saying about climate change is different from the S and the G. And it took me back to last year when Jun ran a really fascinating conference in Seoul, and Jeffrey Gordon gave a paper at it where he said, you know, we need to de-link climate from the S and the G. Now, he said it for different reasons to you. He said it because he thinks there is going to be so much pushback in the United States on the S and the G that that's going to drag climate down, and climate can't be dragged down. It's too critical. But I thought it was, you know, a really interesting take on it, that America is so influential in this regard, and, you know, that pushback has only got much greater since he gave that paper. So, questions in the room, or are you all just relaxed after lunch and wanting us to do all the work? Yeah. So, Dan and then Gen.
So yeah, it's a fascinating paper. I'm just wondering, yeah, Virginia, based on what you said yesterday, just your take on double materiality and the legs that it has beyond the EU, because my sense is that, you know, the EU has embraced this because that's the approach they've taken internally, and now they're trying to push this everywhere externally. And my only guess is that if the Brussels effect works in corporate governance, that they'll drag some countries or companies kicking and screaming, right? Nobody's going to actually do this on their own, but Europe, I guess, has the confidence in market size that they can actually force this, right? So I find it an interesting dynamic because in my mind it seems to be playing out, you know, the rest of the world is in some sense comfortable with single materiality. I think that's it's basically been decided. And really the game in the next, you know, year or two is going to be, does Europe get its way of changing the purpose or the idea of companies around to double materiality, right? Are people going to accept this? And I don't know the answer to that, except that they've drafted their law, since it's been watered down within the EU recently, right? It's applying now to a much smaller scope of companies, how much that will matter. But, you know, I just would like to hear you speak more, because yesterday it seemed that you were suggesting, you know, there's intellectual clarity in double materiality, which I tend to agree with you about. But in terms of sort of feasibility and attractiveness, right? I think everybody hates it outside of Europe. And so it doesn't matter that it is intellectually nice. It just doesn't seem to work. So I'm just wondering what your reaction is to that.
I don't know if I should take that first. Okay. Yeah, so I think there's clarity, not just intellectual clarity, but practical clarity for boards. that's coming out of all of these measures, even the ISSB, we get clarity about the definition of what counts as a climate-related financial risk. So even on a single materiality point, I think we get that benefit from the fact that these things are hardening into some kind of regulation in different jurisdictions. We have to remember, I agree totally with you that double materiality has come out of over a decade of work in the European Union, a very European approach, but it's built on policy choices that were made at the EU level that ground all of this and that are pointing in a totally different direction than the U.S. has taken, for example. So the U.S. Is playing catch up, obviously, in a lot of ways that even in the U.S. system you would think would move forward. But we're not going to see every country embrace that vision necessarily, I think. But isn't it interesting, because the same room would have said a number of years ago, or maybe even today, U.S. corporate governance is international corporate governance. It is world corporate governance, and no one would have thought anything strange about it because it's a big market, because it's influential. So is there anything wrong with that? Well, you've written, again, on kind of, well, that ignores the rest of the world has many different ownership patterns and different jurisdictional differences that maybe need to be taken into account, and especially on the S factor and within Europe as well. They have not pushed forward as quickly as they maybe wanted to on defining social sustainability factors, because it's so diverse, because it's so hard, and that's what the U.S. has struggled with. So we're going to see jurisdictional differences, but there still will be a spillover effect. Is that bad? I don't know. I mean, anything that shames us into doing the right thing is probably helpful, but again, you're absolutely right that it is driven by policy choices that were made by governmental bodies at the EU level and at the member state level that represent a particular context, and that needs to be taken into account for the rest of us. But I will say from Hong Kong, the Hong Kong standpoint is that the government is doing its level best, and consultants are out there popping up left and right to create capacity building services to help SMEs comply with all of this down the food chain. So it's having an effect.
When you say that, a decade ago or maybe 2 decades ago, we would have thought nothing of, US law is the law of the world. In that time, capital market structure has, if anything, become more concentrated, and so US capital market, and US though with institutional investors. But, there was a time, the law matters hypothesis thought the US was leading the way and everybody else would follow in capital market structure, and the reverse has happened. So, go figure. Rosa, anything you want to say on this point? Yep. No, I know Gen's next, but I just, wanted to make sure you didn't want to say anything before I pass over to Gen.
Well, the pushback that I was trying to give was, we actually on the same page. I really enjoy the paper, and I agree with many things that Virginia talks about in the paper. I would say that because Dan is coming from, his comments is basically from the paper that we co-wrote, and we actually think that yes, it in many regards and respects it will continue to be jurisdiction specific because it's driven by the context, as you said. But what we observe is that still, they're powerful or jurisdiction that frame the conversation, and then it basically makes other jurisdictions to follow. Like until recently, before that, it was the United States. Now, in terms of materiality and everything, and sustainability related corporate governance in the European Union. And I believe that because of their, because they're interested in exporting double materiality, otherwise their companies would lose. Yeah, I think that we will have a more powerful effect. And then that's why I asked the question about the shift, because if we're moving to a certain direction, the question is towards what, we're moving. And whether double materiality will be the final destination, or in the end of the day, it will be a big divide.
Yeah. We have 5 minutes. Over to Gen, and then we've got another question there. Oh, hands everywhere now that we know we've only got 5 minutes.
All right. Okay. So I'll try to be brief. So thank you so much for your presentation. So it's not about business judgment rule, actually. So you mentioned that there's a tension between traditional corporate law and with like ESG-oriented capital market regulation. So that's very interesting because so where this tension comes from. So if we have like similar disclosure rule based on environmental law regulation, then nobody would think that this is a tension. This is just an environmental regulation that you companies need to abide by. So there's no regulation, no tension. So, but people still think about there's a tension if we introduce this via capital market regulation. So, so why we think that way? Well, maybe one possibility is that it's more about like soft law. So it don't go through like national parliament or other things. So somehow regulators incorporate soft law, or like or they are forced to follow like EU rules and other rules. So it's kind of a de facto regulation. So maybe there's one thing that comes up is like democratic legitimacy issue. So so if you have like any views, so there and also like Trump supporters also discussed that this is not democratic. So well, I'm not their supporter, but still we have to give some kind of you know, reaction to those kind of arguments. So if you have any views on that, that would be
We're going to take the last two questions so that we make sure we don't lose them. Sorry. Oh, Lin Lin. No, you're right. Okay, Jun. Oh, no, here, yeah.
Thanks, Virginia, for this excellent presentation. I really enjoy your paper and your presentation. I have two questions. One bigger question is about the role of soft law and hard law in sustainable disclosure. We see that especially EU is moving more from moving soft law to hard law in terms of sustainable disclosure. I'm not so sure whether there's any cost-benefit analysis on that, especially for those less advanced economies and for those companies on the supply chain in the context of less advanced economies or developing countries, whether the benefits that will bring from disclosing would outweigh the cost that would imposed on those companies. Because I've faced many inquiries from those listed companies and those companies on the supply chain. They're actually facing a lot of operational problems, and they are quite worried about the cost. So that's one. And the second is about the fiduciary duties that it seems that you talk about it in the context of corporate law. And I wonder how about the fiduciary duties in the context of fund, for example, ESG funds. Especially there is, I'm more willing to know more about, you know, Hong Kong's approach in terms of the fiduciary duties of the trustee in those funds that are organized as trusts, or the fiduciary duties of the general partners type, you know, fund managers in the context of the fund that is organized as a limited partnership, for example.
Sorry, I just need to interrupt because we need to get Jun's question because we only have 1 minute left.
Okay, so that's all for my questions. Thanks.
And we will. Virginia tells me she can answer all three very quickly, so that's good news to me.
Yeah, so thank you very much, Jenny, for reminding our nice Seoul conference last year. In line with Ken's questions, I think that there's no big conflict between corporate law and sustainable disclosure. The reason being is that maybe the difference with the environment law disclosure and the capital market sustainable disclosure would be that in the new sustainability disclosure regime, you need to disclose your plan how to reduce your greenhouse gases in the future. But once again, this should be subject to the fiduciary duties under the corporate law. So I don't think there can be a big conflict between corporate law and capital market disclosure law. What I'm more worried is about the conflict within the capital market law. So for example, reading your rules of Singapore and Hong Kong in your presentation, it's very clear that the materiality is single materiality. They are saying financial information in the wording. While when we are looking on the sustainable rules that are coming like globally, like for IFRAC, for example, they have issued the guidance on materiality recently, and they are like obviously doing the double materiality. While I don't think that they are revising their capital market law or MAR or things like that. So, what I hear your thought about that.
Go for it, Virginia.
Okay.
This
Yeah,
is all we've
I'll
got
talk to whoever else is raising their hand. We can talk during the break. Okay, the source of the tension, why it's different is because, okay, so again, we don't have legislative action. This is all happening through like stock exchange rules and regulatory initiatives. So that point is a fair one. But they are requiring and introducing corporate governance reforms through these regulations. And so the way that that changes company law is it's narrowing the discretion. Normally this is all permissive, you can do it or you don't have to do it. My argument is it's narrowing discretion, and I think that matters. So it's kind of indirectly mandating. Number two, the soft law, hard law, and the cost-benefit analysis. So the answer is the EU has done a bunch of cost-benefit analysis in the process of developing like the double materiality and the taxonomy and all the frameworks. So there's some really great reports you can read out there. And in fact, I think the SEC probably consulted some of them because we had to defend on cost-benefit grounds. The issue is the value chain cost, and I think that's what you're going to. But there's some really interesting developments, including in Europe. I just learned that EFAS is kind of over EFRAG, but they're working right now to develop tools to help the SMEs that are listed, that are within the scope of the regulations, to comply through very kind of user-friendly mechanisms. And I've also recently learned that Singapore and the exchange here is working very actively to also kind of make things user-friendly, both for investors, but also for companies that need to kind of come into compliance. And then in terms of different standards, I'll speak to the fiduciary duty of funds thing I think we'll be talking about tomorrow with another paper that I'll comment on. But the different standards, obviously there was hope that internationally these rules would harmonize so that there would not be differentiation among different capital markets. That hasn't happened, but it's mostly happened. So ISSB will be the international standard, and then Europe will go above and beyond, and the ISSB has taken the position that it wants to set kind of the floor, and that the hope is that all capital markets will converge around that, and that will be more efficient and more effective for capital market participants, both on the investor side and on the company side.
Masterful or mistressful. Everybody thank our speakers.